Hello everyone and welcome to this month's investment update for the month of March for Generate Investment Management. I am Matthew Hanchet, Investment Distribution Manager here at Generate, and I'm joined by Ayrton Oliver. Thank you for joining me this morning, Ayrton.
Good morning.
So there's been heightened geopolitical tension recently, specifically around Iran and the Middle East, of course, which has definitely influenced energy markets and global sentiment. What does that mean for fixed income? We obviously have fixed income and we have our fixed income managed funds, but we also have fixed income in most of our diversified strategies. What does that mean? How's the events typically impacted fixed income markets?
Yeah, sure. Yeah, there's obviously a lot of tension at the moment in the world, and it usually flows through into fixed income in three different ways. So the first is the risk sentiment channel. So that channel comes through when people look to sell out of equities and risky assets and move into high quality, such as government bonds, as a flight to safety. And so that usually comes through as lower yields in government bonds. It can feed into lower yields in corporate bonds, although it's a little bit cloudier there when corporate credit spreads widen on the risk-off moves. The second channel is that inflation and energy channel. So with oil shocks coming through, that means that oil can't get through. So there's going to be supply chain disruptions, either delay in oil or heightened prices. Around 20% of oil and LNG goes through that strait, especially to Asia, which is one of our major trading partners. So that shock then can cause inflation expectations to go up, and that can cause wage prices, and then supply side issues, causing just a general inflation throughout the economy. And that will end up with the central bank wanting to hike rates. So that can be negative to bonds. And lastly is the risk, the growth outlook. So you get the risk sentiment flowing through to slower consumer demand, slower spending, and just consumer sentiment going south with the risk off and around the world. So that can cause growth to slow, and central banks then may need to respond by cutting rates.
Fantastic. And I just wanted to zero in a little bit more on that inflation question. Obviously, with geopolitical uncertainty, and we've got different central banks around the world at different parts of the interest rate cycle. Are you concerned about oil prices, for example, increasing inflation or affecting inflation in any way? How are you positioning our fixed income portfolios to manage that?
Sure. Yeah, as you said, there's central banks that are cutting at the moment. There's some on hold, like ours, and there's some are hiking, like the RBA. And so this inflation shock, potential inflation shock and risk-off move around the world is definitely going to cloud that outlook for them, and makes it a lot less easy for them to judge what's going to go on. For me, on the inflation side, the oil is important as a key input price. It does usually feed through as a second order effect, which that means oil price goes up, input costs go up, people then ask for higher wages. Those wages then go into higher service inflation, and it go on and on and get an inflationary cycle, and that's what the central banks are worried about. This only normally happens if the oil price is a permanent shift higher. If it's just a temporary move, it may just be a blip, and central banks will look through it. At the moment, the markets are looking at it like it could be a little bit longer than expected, and so we may see an inflation problem in some parts of the world. It really does depend on how the economies are going. So if you've got a tight labour market and people can ask for those higher wages, then inflation can take hold quicker. If you're in an economy where growth is slowing and the labour market's not that tight, it's likely just going to be a demand shock because people have less to spend. The oil price has gone up. That's going to cost them more. It's an income tax, basically. It's gone up. You've got less to spend, and so that hits consumer demand, and therefore slower growth and slower inflation. So I think it really depends on which economy you're looking at, but I believe at the moment it's probably looking on the way that it could be inflationary in some parts of the world, yet to see how long this kind of shocks last for and if it becomes permanent. In terms of positioning, there's three ways that you can really look at it. So one is having high quality government bonds and investment grade credits that can withstand the volatility of these macro events. The second is the active duration. So being an active manager, we can change our interest rate sensitivities across the curves and across the fund when we need to. At the moment, we're a little bit overweight duration, so that should mean that we will benefit if interest rates can stay stable or fall from here. As I said, they might fall if we get a global growth slowing or economic downturn. Lastly is just monitoring that inflation outlook. So if it does become evident that it's going to be more persistent, then we can adjust our interest rate sensitivity to take into account that probably we see central banks being a bit more hold-offish or maybe even hawkish to try and combat inflation.
Now I want to talk about FX and currency hedging. So within our funds we have varying rates of currency hedging, and it's been well publicised, the New Zealand dollar's performance against the USD. That certainly has been affected quite significantly post all the tension that's going on in the Middle East as well. We saw highs of the NZD versus the USD of as high as 87 cents in the dollars back in the mid-2010s. It's obviously changed quite a bit now to below 60 cents in the dollar, I believe, this morning. What are your thoughts on currency? Obviously, a lot of it's driven by the different interest rates in the different economies around the world. What should investors be thinking about as currency hedging goes?
Sure. Yeah, you make a good point. Currencies are a very big, good indicator of macro events. They move very quickly. There's a couple of key things that drive them. So specifically for New Zealand dollar is interest rate differentials, as you mentioned. That's mainly you're looking at the RBNZ rate versus the federal funds rate and the outlook for those two rates. Also, you have in there the global kind of risk sentiment. So when risk goes bad, people want US dollars. They chase US dollars higher. So that sends our currency down. You've also got the commodity prices as a key driver for New Zealand, especially things like agri and dairy. And then lastly, you've just got general supply or general demand for US dollars. So if people are looking to buy US dollar assets and US economy is the one that's booming, it's usually going to be a US dollar positive. And so they all come together to kind of drive where the currency is going. At the moment, we're seeing that risk off move. And so that's the overarching driver at the moment. With risk off, people want US dollars. They're selling New Zealand dollars, selling Australian dollars, and pushing us back down towards those lower end of the range. As you mentioned, we hedge around 50% of our US dollar exposure. For Kiwi investors, having offshore currencies against New Zealand dollars can actually dampen the blow for risk off moves. If you say US stocks are going down at a time when US dollar is going up, that means that the return in New Zealand dollars is not going to be as negative as it might have otherwise been because the currency, the US dollar, has gone up, which is what the assets are based in. So it does dampen the blow when you get some volatility. That's why we only hedge around 50% of the moves. It can increase volatility over time, but on average, when the normal relationships hold and the New Zealand dollar goes down when stocks go down, it can be a benefit to Kiwi investors.
Then likewise, when in times of economic prosperity, the New Zealand dollar can go up as well, as along with your stocks. You can also get that added increase as well sometimes.
That's why we've got hedges on, because if we do have our offshore investments in US dollars and the New Zealand dollar is also going up, we want to have some of that hedged back to New Zealand dollars to make sure we're not giving up too much of the gains by having it all in offshore currencies. And from now, at the moment, it looks like the New Zealand dollar had been set to go back up. We're starting to see global growth was picking up. You're starting to see New Zealand economy rebound, the RBNZ potentially hiking rates next year, and with the Fed cutting rates, and the demand for US dollars kind of coming off as global growth picks up. However, that's now clouded with the risk-off environment. So if that risk-off from the Iran conflict can die down over the next couple of weeks or months, then maybe we'll see the New Zealand dollar start to rebound again.
Very interesting to see how short-term and long-term this conflict lasts. I want to talk about term deposits as well. So obviously throughout the periods of high inflation in New Zealand, I'm thinking sort of 2022, 23 in particular, term deposits got to a really attractive rate, and we saw a lot of people flood into term deposits. Now we're starting to see with the interest rates that have been dropping, we're starting to see those term deposits look a little bit less attractive than what they once were. Why would something like the fixed income managed fund, for example, which invests in your strategy, why would that be perhaps a more appropriate solution for those investors?
As you mentioned, term deposits have come off quite a bit from the highs with the central bank cutting rates. For me, I think the reason why you want to be invested is the active management. So we can take advantage of macroeconomic conditions as they change. So we can adjust our interest rate exposure, benefit on when we think rates are going down. We can adjust it when we think rates are going up. And this gives us a way to add alpha with changing macroeconomic conditions. Also, you get diversification, so you've got different kind of issuers. We can go across the credit score. It's not just one issuer, a bank, a term deposit. And you can also get a active management of credit risk. So we actively choose different credits for risk and reward that give us better returns than in term deposits. And especially at the time when we've now seen rates probably at the lows in terms of the central bank rate, the interest rate curve is starting to point upwards again, slope upwards, so you are getting paid and you are getting returns for going out the credit curve into bonds, away from term deposits. You can get capital gains when rates go lower. It does mean there is risk if rates go up very quickly, but in general it does mean you can perform when interest rates go the right way.
And just in layman terms, that just means that you've bought a bond a year before that has paying X amount of return, and then when interest rates drop, that means that the bond that you're currently holding is more attractive than what's out there in the market to buy.
Yeah.
Now, when we talk about volatility, it's something that we're definitely expecting to see over the past few weeks and for the weeks to come. Whether the volatility is coming from geopolitics, inflation surprises, or currency movements, how does your approach aim to minimise capital volatility?
So again, that goes back to the active management. So we have the ability to change around our duration, so our interest rate sensitivity pretty quickly, and we can change around our credit relatively quickly. If we think interest rates are going to fall because the economy is looking like it's going to slow, or the central bank needs to provide support, we can add duration and add longer bonds and benefit from falling interest rates. If we feel like inflation is becoming entrenched and becoming more persistent and the central banks are going to get worried, we can start to reduce our interest rate exposure or minimise the downside for when interest rates go up and bond prices fall. If we feel like there's certain sectors of the economy which is going to struggle from different credits or different credit events from either volatility or inflation or a downturn in the consumer, we can pivot away from those sectors and make sure we're in the higher grade governments or in sectors that are not going to be as influenced or impacted by inflation. So the aim is to minimise volatility, not completely reduce it, but we can use our tools to change around our interest rate exposure, change around our credit exposure as we see the environment changing. We can also change around our currency exposure. So as I mentioned earlier, if we feel like the New Zealand dollar is going to be falling significantly due to a risk off and the US dollar going bid, then we can and reduce our hedging ratio, which means that we've got less of a hedge on, we'll be more exposed to the US dollar, which should dampen some of the moves in global equities.
Fantastic. And I just want to talk about the role that fixed income plays in a portfolio. So obviously in the earlier days, advisors would put together typically a 60-40% portfolio between 60% equities and 40% bonds, or vice versa. Now we're starting to see more alternative assets come into portfolios, things like private equity, private credit's become very popular. What role do you think today fixed income plays when constructing portfolios for advisors and for clients alike?
So I think fixed income is an important part of portfolios. It depends on your outlook on risk and your time horizon. So it may be more important for someone looking for a more stable return close to retirement. Fixed income can give you income generation, which will complement your growth parts of your portfolio or your equity part. I give you diversification across from issuers, so you can get different issuers and different parts of the economy, exposure to different parts of the economy from bonds and from fixed income. And also gives you, which I think is probably the main part, is diversification away from growth assets. So when things slow or when growth assets are struggling, you can get a pickup from bonds and they might perform even better over the medium term, especially in economic downturns.
Thank you, and that brings us to the end of this month's investment updates. Please do remember to like, share, subscribe this content on any channels that you can. Thank you, Ayrton, for joining me this morning. It's been an absolute pleasure and very educational.
Welcome. Cheers, Matt.
Thank you.